Welcome back to the deep dive. Ever find yourself maybe late at night staring at a tax form and just thinking, is there a simpler way? Or maybe, am I missing something? Leaving money on the table? Hmm. Yeah, you're definitely not alone there. We're all kind of looking for that shortcut to feeling confident, especially with taxes, right? So today we're diving deep into the real fundamentals of filing your 2024 taxes. We want to break down those key decisions, those details that can actually make a difference to your savings. Think of this as your personalized guide through the tax maze, designed to give you those aha moments without all the confusing jargon.
Exactly. A lot of people think tax season is just about numbers, but really it's about understanding the rules that apply specifically to your situation. So our mission today is to sort of demystify the key parts of IRS Publication 501 for you. We'll focus on the absolute basics. Do you even need to file? How does your filing status impact, well, everything? And the power of dependence often overlooked. And of course, that big one, the standard deduction. We'll unpack these piece by piece and show how knowing this stuff can lead to real tax savings.
Okay, let's do it. This isn't just paperwork. It's understanding the system so you can potentially keep more of your hard-earned cash. So let's start at square one. How do you even know if you have to file a federal income tax return? Is it just about how much money you made?
That's the perfect starting point. And it's a bit more than just income. The IRS has clear guidelines based on, yes, your gross income, but also your filing status, your age, and crucially, whether someone else can claim you as a dependent. For most folks, if your gross income in 2024 hit a certain level, like say $14,600 if you're single and under 65, then yeah, you generally must file. Those amounts go up if you're 65 or older, or, based on your filing status.
Okay, gross income. Does that mean literally everything? Like even non-cash stuff? If I bartered services for, say, a laptop?
Great question. And yes, pretty much. Gross income is all income. You get money, goods, property, services, unless it's specifically tax exempt. It includes income from outside the U.S., potentially gains from selling your home, even if some might be excluded later. For self-employed people, it's usually your total sales or receipts before expenses, plus any other business income. And here's a key thing. Even if you calculate you owe zero tax, you might still be required to file. Not filing when required can lead to penalties.
Right, that couples the must file.
Right.
But I've heard there are situations where you should file, even if the IRS doesn't strictly require it. This sounds like a smart saving strategy.
Yes. This is where it gets really interesting for boosting your refund. Even if you're below that filing threshold, you absolutely should file if you can get money back. Think about it. Did you have income tax withheld from your paychecks? Did you make any estimated tax payments during the year? Filing is how you claim that back. And even more importantly, you need to file to claim refundable credits. These are things like the Earned Income Credit, or EIC, the Additional Child Tax Credit, the refundable part of the American Opportunity Credit for education, or the Premium Tax Credit for health insurance. These credits can literally put money back in your pocket, even if you didn't owe any tax to begin with. They're incredibly powerful.
Wow, okay. So if any tax was withheld, or if you even think you might qualify for one of those credits, filing isn't just compliance, it's actively claiming your money. That's a huge potential saving right there. Now, okay, let's say you've decided you need to file, or you want to file to get money back. One of the very first and maybe most impactful choices you make is your filing status. How important is this, really?
Oh, it's absolutely fundamental. Your filing status affects whether you have to file, it sets your standard deduction amount, it influences your tax rate, and crucially, it determines if you're even eligible for certain deductions and credits. If more than one status could apply to you, the golden rule for saving tax is always pick the one that gives you the lowest tax. Lowest tax, got it. So what are the main options and how do they stack up in terms of, well, saving money? There are 5 main ones: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. Single is straightforward. You're unmarried, don't qualify for another status. Standard deduction for 2024 is $14,600. Married filing jointly, MFJ. If you're married, you and your spouse can file one return together, combining income and deductions. This almost always leads to a lower overall tax bill for the couple. Plus, you get a much higher standard deduction, $29,200 for 2024, compared to filing separately. And you unlock access to more tax benefits. Just remember, with MFJ, both spouses are responsible for the tax, jointly and individually. Married filing separately, MFS. You can choose this if you're married. But be careful. It usually results in a higher combined tax than filing jointly.
Okay, that MFS sounds like a big red flag for tax savings. Can you dig into why it's usually less beneficial? What are the actual downsides?
Absolutely. This is where you really need to think strategically. Choosing married filing separately often brings a whole host of disadvantages. Your tax rate is generally higher. You usually can't take certain credits, think child and dependent care, the EIC in most cases, education credits, even the student loan interest deduction, gone. Your capital loss deduction limit gets cut in half, only $1,500 instead of $3,000 on a joint return. And here's a huge one. If your spouse decides to itemize their deductions, you cannot take the standard deduction. You must itemize too, even if the standard deduction would have been better for you. Even if you can take standard deduction, it's half the amount of the joint return deduction. Plus, things like the credit for the elderly or disabled might be off limits, and more of your Social Security could become taxable if you live together. So, while it's an option, MFS rarely saves money unless there's a very specific reason, like protecting yourself from tax issues related to your spouse, or maybe some very niche AGI limitation benefits. Always calculate both ways if you're considering it, but MFJ is usually the winner for savings.
Wow. Okay, so unless there's a compelling non-tax reason, married filing jointly is typically the way to go for married couples looking to save. That's a really important takeaway. What about head of household and qualifying surviving spouse? They sound potentially beneficial.
They definitely are, and offer significant savings if you qualify. Head of household, HOH. This status gives you a lower tax rate than single or MFS and a higher standard deduction, $21,900 for 2024. To qualify, you generally need to be unmarried or considered unmarried, pay more than half the cost of keeping up your home for the year, and have a qualifying person, usually a child or dependent relative, living with you for more than half the year. Pub 501 actually has a worksheet to help figure out that keeping up a home cost includes rent, mortgage interest, property taxes, utilities, repairs, even groceries eaten in the home. Qualifying surviving spouse, QSS. This is a fantastic benefit, often missed. If your spouse died in 2022 or 2023 and you haven't remarried, you might qualify. It lets you use the beneficial joint return tax rates and the highest standard deduction, $29,200 for 2024, for 2 years after the year your spouse died. You need to have a dependent child or stepchild living with you that you provide a home for. You don't file a joint return, but you get those joint return benefits. It's a big help during a difficult time.
So these statuses aren't just boxes to check. They're active ways to lower your tax bill. Knowing which one fits you is key to maximizing those savings. Okay, moving beyond filing status, another huge area affecting your tax bill is dependents, claiming dependents. What exactly is a dependent, and what kind of tax benefits do they unlock?
Right. Knowing who qualifies as your dependent is crucial because it opens the door to valuable tax credits. And remember, credits directly reduce your tax, dollar for dollar, much better than deductions usually. A dependent is either a qualifying child or a qualifying relative. The rules can get a little tricky, but understanding them is vital for tax savings.
Gotcha. Let's start with qualifying child. What are the tests you need to meet there?
Okay, for a qualifying child, there are 5 main tests you have to satisfy. 1. Relationship. Must be your child, stepchild, foster child, sibling, half-sibling, step-sibling, or a descendant like a grandchild. Adopted kids count as your own. 2. Age. Generally under 19 at year-end or under 24 if they're a full-time student for at least part of 5 months of the year. And they have to be younger than you or your spouse if filing jointly. No age limit if permanently and totally disabled. 3. Residency. They must have lived with you for more than half the year. There are exceptions for temporary time away, like for school, illness, or military service. 4. Support. This one trips people up sometimes. The child cannot have provided more than half of their own support for the year. Good news for students. Scholarships generally don't count as the child providing their own support. Pub 501 has a worksheet for this too. 5. Joint return. The child can't file a joint return with their spouse for the year unless, and this is a key exception, they're only filing that joint return to get a refund of taxes withheld or estimated taxes paid.
Oh, that last one is interesting. So a married child might still be your dependent if their return is purely for a refund. That's definitely an aha moment. Okay, what about a qualifying relative? How is that different?
Right, the qualifying relative has 4 tests, and they're a bit different. 1, not a qualifying child test. This person cannot be your qualifying child or the qualifying child of any other taxpayer. So that 22-year-old college grad living with you who earned too much to be your qualifying child, they might still be your qualifying relative. 2, member of household or relationship test. They either must live with you all year as a member of your household, or they must be related to you in specific ways listed by the IRS, parents, grandparents, siblings, aunts, uncles, in-laws, etc. Relatives in this list don't necessarily have to live with you all year. 3, gross income test. This is a big one. Their gross income for 2024 must be less than $5,050. That's not a lot of income. 4, support test. You generally must provide more than half of their total support for the year. Support includes things like food, lodging, sarmesic. Remember to count the fair rental value of the space they live in, clothing, education, medical expenses, travel, etc.
And remember, their own money only counts toward their support if they actually spend it on support items.
Okay, so you figure out someone meets all those tests, they're your dependent. What's the actual tax benefit? What does that translate to in savings?
It translates into potentially significant savings. Claiming a dependent allows you to take either the child tax credit, if they're a qualifying child under 17, or the credit for other dependents, for qualifying children too old for the CTC, or for qualifying relatives. These credits directly reduce your tax liability. That's money you don't have to pay, which is a major tax-saving advantage.
But what happens if, say, two people could claim the same child, like in a divorce situation, or maybe a child lives with a parent and a grandparent? That seems like it could get complicated fast, and someone might miss out on savings.
You're right. That's a very common scenario, and the IRS has specific tiebreaker rules to handle it. These are really critical to understand to make sure the tax benefits are claimed correctly and optimally. Basically, if a child meets the qualifying child test for more than one person, only one person can actually claim that child for most of the related tax benefits. The child tax credit, head of household status, child care credits, EIC, etc. So the rules generally go like this. If only one person is the child's parent, the parent gets to claim the child. Pretty simple. If the parents don't file jointly, the parent the child lived with for the longer time during the year usually claims them. If the time was equal, it's the parent with the higher adjusted gross income, AGI. If no parent can claim the child, maybe the child lives with a grandparent, then the person with the highest AGI among those eligible gets to claim the child. Divorced or separated parents have special rules, often involving Form 8332, where the custodial parent can release the claim for the child tax credit to the non-custodial parent. But here's a crucial point often missed. Even with that release form, the non-custodial parent generally cannot claim head of household status or the earned income credit based on that child. Those benefits usually stay with the custodial parent if they qualify. Misunderstanding this costs families money every year.
Wow, yeah, those tiebreaker rules show just how nuanced this can be. It really sounds like clear communication between everyone involved is vital to make sure those valuable tax benefits aren't lost. Okay, we've talked credits, direct tax reduction. Let's switch gears slightly to deductions, specifically the standard deduction. This lowers your taxable income, right? How did that work, and how do you choose?
Exactly. The standard deduction is a fixed dollar amount that reduces the income you actually pay tax on. It's designed to simplify filing for millions of taxpayers, meaning you don't have to track every little deductible expense. You generally have a choice. Take the standard deduction for your filing status or itemize your deductions if you have enough specific expenses. The smart tax saving move. Choose whichever method results in the larger deduction because that means less taxable income and ultimately a lower tax bill.
Makes sense. So what are those standard deduction amounts for the 2024 tax year?
For 2024, the basic standard deduction amounts are: for single or married filing separately, it's $14,600. For married filing jointly or qualifying surviving spouse, it's $29,200. And for head of household, it's $21,900. Keep in mind these amounts are higher if you or your spouse, if filing jointly, are 65 or older or blind. For example, a single person age 65 gets an extra boost, making their standard deduction $16,550.
Are there any situations where you just can't take the standard deduction, or maybe it gets reduced, another potential trap?
Yes, there are a few important situations where your standard deduction is either zero or limited. Your standard deduction is zero if you file married filing separately and your spouse itemizes. You mentioned that earlier, it forces coordination. Also zero if you're filing for a short tax year because you changed accounting periods, or if you are a non-resident or dual status alien during the year, with some exceptions. And here's a really common limitation. If someone else can claim you as a dependent like that working teenager living at home, your standard deduction is limited. It's generally the greater of $1,300 or your total earned income plus $450, but it can't exceed the regular standard deduction for your filing status, $14,600 if single, for instance. Pub 501 has a specific worksheet just for dependents to figure this out.
Right. That's super important for parents with kids who have summer jobs or part-time work. So knowing all that, how do you decide when it's actually better to itemize instead of taking that standard amount?
Simple rule. You should itemize if your total itemized deductions add up to more than your standard deduction amount for your filing status. It's a direct comparison. You might find itemizing beneficial if you had, say, large medical and dental expenses that exceed the threshold based on your income, paid a significant amount of home mortgage interest or state and local taxes, those are capped, had large uninsured losses from things like fires or theft in a federally declared disaster area, made substantial donations to qualified charities. It's always worth running the numbers both ways. Add up your potential itemized deductions, medical, certain taxes, interest, charity, and compare that total to your standard deduction. Pick the bigger number. Sometimes, even if itemizing gives you a smaller deduction federally, it might provide a large benefit on your state tax return. So that's another factor to consider.
Excellent point. It's not automatic. It requires doing the math to see which path saves you the most money. Okay, we have covered a lot of ground today, from figuring out if you even need to file to strategically choosing your filing status, understanding the rules around dependents, and that big choice between the standard deduction and itemizing. It really drives home that tax prep isn't just about compliance, is it? It's an active opportunity to make informed choices that can genuinely affect your bottom line.
Exactly right. The fundamental idea here is that knowledge empowers you. By breaking down these core pieces of your tax return, you're not just learning facts, you're gaining insight into how the system works and how your specific life circumstances fit into it. Thinking critically about, say, your filing status or who qualifies as your dependent, those aren't just minor details. They can lead to really meaningful differences in how much tax you pay.
So what does this mean for you listening right now? Next time you sit down with your taxes, try to see it less as just filling in boxes and more as a series of decisions. Each decision has consequences for your tax liability and your overall financial health. Understanding those consequences is where the real power lies.
Which brings up an interesting question for you to think about. How might your approach to taxes and maybe even your financial freedom change if you started tracking and understanding things like potential dependent support costs or household expenses that feed into head of household status throughout the year instead of just scrambling at tax time?
That is a powerful thought to consider. Proactive planning versus reactive filing. And hey, remember, the IRS itself offers a ton of resources. Free file software options, volunteer help programs like VIATA and TCE, useful online tools like the tax withholding estimator. Check out irs.gov. Keep learning, keep digging deep, and keep applying those insights to save yourself some money. That's it for this deep dive. Until next time, stay well informed.